Good day and welcome to the Korner BCI Flexible Fund Manager Commentary for the 6 months to the 30th of June, but we're also providing an update to the 31st of July, in part because we're recording this quite late, along with the rest of the series, and in part because a lot has happened and it's worthwhile bringing you up to date with some of the more recent developments. Just a reminder about the positioning of the fund. We apologize, we've shared this before, but we think it's useful. It's a flexible fund that gives us maximum flexibility to vary assets and asset classes as we see fit, and we do, as you will see, express that. Technical benchmark is 70% FTSE shareholder weighted capped, and 15% is the SA listed property index, and 15% is the STEFI cash index, that composite index. But frankly, we don't manage the fund to beat the benchmark specifically. We also don't manage the fund to beat the ASISA category. We manage the fund as effectively as we can to offer long-term inflation-beating returns with as little downside as possible. The fund is very South Africa focused, in part because the bulk of the clients that are in the fund, which are existing Korner Perspective clients, have significant offshore portfolio exposure, generally in the form of segregated direct portfolios, and that then liberates us to offer or express ourselves in a fund that we believe invests in things that are kind of unique to South Africa and give us unique opportunities. For example, the opportunity in smaller and mid-cap companies where we can do our own research, engage with management and form opinions, rather than following, for example, a fund that seeks to offer a certain level of rand protection, which we believe a lot of funds tend to do. Our core investment philosophy is value, although in the South African context it's actually quite difficult to be too rigidly in value. And we also believe that, frankly, it is quite useful to be a little bit dynamic in your investment thinking. And then finally, assets are only included, as we've discussed before, and I think as we've demonstrated, when we believe they will add value. All right, just then quickly looking at the fund review to the 30th of June. And then this is obviously a 6-month view. Starting with asset allocation, if you look at the asset allocation at the 30th of June, and we've decided now to include the big bank preference shares, which will represent about 3% of the overall fund, in the equity bucket. And that's really just so that we can sync this reporting with what happens in the minimum disclosure document. Cash sits at 12.5%. Bonds at 10.3%, and basically zero in listed property, versus our benchmark, which is 70% in the STEFI, 15% in 70% in the SWIX, the JSE SWIX, 15% in STEFI, and 15% in property. So clearly the fund is quite uniquely positioned to its benchmark. Right, just having a quick look at the asset allocation over time, going back to 2019, shortly after the fund was launched. As you can see, now equity up at over 70%. You can see income funds and money market cash that used to be around 50% has been shrunk all the way down to, as we saw, 12-odd%. We've increased the bond exposure, which is that top lighter blue bar or area, basically since yields got pushed quite high. We saw specific opportunities we've discussed in the asset market reviews. We have, in percentage terms, maintained our big bank pref holdings fairly constantly, but that's obviously resulted in us adding as the assets in the fund have grown. So just very quickly, relative to benchmark, including the prefs, we're around 7% overweight equity. If you exclude the prefs, still about 4% overweight equity. Cash, we are underweight around 2.5%, virtually completely underweight, almost 15% sitting in underweight property, and then bonds and prefs we are 10% overweight. So really what we would conceptually have allocated to property, we've redirected into bonds. Yeah. All right, the motivation for the current weightings, I think a lot of this, if you did watch the asset market review and probably the local portfolio commentary, was probably fairly self-explanatory. Overweight equity really just boils down to really attractive valuations, both PEs and discounts to NAV on investment companies, and very attractive dividend yields. If you just compare, for example, the yields on big banks, they compare very favorably with what you're getting on cash. Then the bond holding, we discussed this in detail, but the bottom line is that the bonds offer a lovely yield pickup over cash, particularly in a falling rate environment. And also we felt, as we've seen, that you would get on traditional vanilla bonds, nice capital gain as those yields normalized. And then prefs paying well over 80% of prime, but slightly, paying around 85 to 90% of prime. So the nice thing is when yields compress by, say, 100 basis points, your yield doesn't quite sacrifice. So looking very good, and we believe that those will ultimately be delisted, those that remain. Underweight property, we'll discuss in more detail in a minute. And then cash, we're largely neutral, but generally preferring longer dated paper with the absolute cash kind of at around the 5% mark, simply to provide liquidity in the fund for opportunities. All right, I think anybody who sees that benchmark and sees the significant underweight may really want an explanation as to why we're still so underweight listed property. And we'll just unpack that very quickly now. All right, so we really see two parts to this. The first one is let's call it the sector specifics in terms of office and retail particularly, but then also the growing cost pressures, particularly in the form of administered prices like municipal accounts and Eskom, which are very difficult to pass on. So generally in the office space, we feel that even before COVID, there was a lot of supply around, but post-COVID, we're seeing a massive rebasing of corporate appetite for office space. And we also believe that when current leases expire and there's a renegotiation cycle, that we're generally going to see landlords battling to pass or to renew leases at higher rates. So we believe there'll probably be some downward pressure on rate per square meter, and that in large part is because a lot of tenants themselves are having to pick up administered prices. So the rent and utilities bill has become increasingly a bane of existence for a lot of companies. And then in retail, part of it is disposable income. Hopefully in the next couple of weeks we get some reprieve from the SARB, as we've discussed. But also we sense that there's change in consumer behavior, the way people spend their money, particularly the newer generation. And we believe that, frankly, a lot of big malls are going to have to recalibrate away from kind of just being a retail or shopping experience, more in towards a lifestyle, and that'll probably come with changing economics. But most importantly, we think e-commerce is becoming a big force. You've seen it in companies like ShopRite and TFG, how significant those e-commerce initiatives are becoming, and that's a global phenomenon, and it's really starting to have an effect, we believe, on appetite for retail space. And then again, basic supply and demand. But as we say, the kind of the core hypothesis is it's going to be increasingly difficult for landlords to deliver distribution growth. Which leads to exactly this chart, or this page here, this slide, and that really basically says that yields and distributions really are the story. You can sort of argue and think about it however you like. The bottom line is, from 2019 when COVID struck, you've seen on a variety of levels, obviously space, but also rentals, and also interest rates, obviously having moved higher, have all conspired to see those distributions from Growth Point, Redefine, and Hyprop, three of the big ones on this slide, all well down on where they were, and in fact not even growing if you compare the current financial years to the 2023 years, and then also obviously 25. So what we're saying is that although the yields look better, and the index has recovered, if you took an average of these companies, and obviously Vukile has its own unique story, and that's the reason for the relative growth in distributions relative to its peer group. So although the yields are looking better at probably about 8.5%, if you took a simple average of these, they're still below what you would get on short and medium dated government bonds, which really is, we believe, the key story. Having said all of that, we are warming to listed property. We had a very good look at Equitas. We like the story, but we're just a little uninspired by a couple of the company specifics, particularly around the rates that they achieve and the growth that they're likely to see. Looking at the equity bucket, obviously all important, with over 70% sitting in equity. We discussed this before, we won't dwell on it, but a lot of this will come out in the subsequent slides, but we're still very exposed to financials because that's where there's been a lot of value. We still have almost no resource exposure, although we are warming to it. If you look at what somebody like BHP Billiton has done, or BHP, as well as Anglo's, there's probably growing merit in starting to nibble at some commodity plays. Still very exposed to NAVs. So really it's been a fairly, I suppose some would call it a contrarian view, but very focused on underlying value. And as you'll see also in this next slide, a fairly equally weighted portfolio. Some of the bigger holdings are obviously the banks, Standard Bank and ABSA. African Rainbow Capital is a story, as we've discussed before, that we like very much. It's one of our biggest holdings, along with Aspen. But as you can see, a fairly equally weighted portfolio. Quite a few holdings around the 4-5%, 3-4-5%, and that's really just us trying to expose clients to assets that we believe have good merit. The smaller holdings bucket there, sort of around 10 o'clock on the chart, represents, if memory serves, 5 shares. So in total, a little over 20 counters in the equity bucket. The star performer really Bell Equipment in the last while, obviously on the takeout, but we've also seen some of those bigger holdings, the likes of Standard Bank, after the GNU, but also after the results, doing very, very nicely, as of companies like TFG and Aspen. So there have been a couple of, let's call them underperformers. Probably something like Naspers has been fairly dull, fairly weak performance out of Amplat, which is a very, very small holding. And Ethos Capital has been disappointing, but a lot of counters have contributed to the better performance. Also, interestingly, we've as you'll see in a second, we've added quite a lot of what we would call gear market plays in the form of Coronation and 91 and Old Mutual, and that was really just a bet, in inverted commas, on the rally in the equity market that we felt was overdue. Just a couple of the top 10 equity holdings that have changed quite a lot over time. We showed this slide. This actually is the slide from the previous presentation, and you can see, things like Discovery, for example, and Grand Parade are gone completely. More recently, we've also sold things like PHP and British American Tobacco, whereas you've seen counters like ARC, Fushini, Bell Equipment all become quite significant holdings in the portfolio. Really, we discussed this in more detail in the previous videos, but we've got quite a lot of allocation to counters that are going to deliver 10% plus earnings growth over the next couple of years, with PEs at 10 or under, or around 10. And you can see counters like Standard Bank and ABSA, Aspen, some of the bigger holdings there. TFG earnings growth is going to be slightly lower, but yeah, we feel that there's a lot of optionality there. I suppose there's a slide that reflects our value orientation. In bold, you can see some of the NAV plays, basically the either investment holding companies or implied NAV stories. It was African Rainbow Capital, Argent, Bell, Ethos, Naspers, even New World we see as an NAV play, as we Mutual, Raynet, and Remgrow. So fairly significant NAV bet with all of those, or pretty much all of them trading at a discount to net asset value. We discussed this slide previously, possible corporate action plays. More likely, we've seen Bell Equipment, which is on this slide. But also we think more could come from ARC, Argent, and New World, which is fairly new. Whereas the others we think are less likely to see classic corporate action. But we've seen the likes of Ethos Capital's board announcing a very comprehensive plan on how they're going to realize capital and return capital to shareholders. All right, the geared marketplace. So really what we're saying is companies like Coronation and 91 don't just give you exposure to the markets. If the markets do well, they outperform. We added some of those, as well as Old Mutual. Old Mutual is somewhere between kind of an embedded value NAV play and a geared market play. And I think Coronation particularly has done very well, as we discussed in the local portfolio review, and that in large part on the combination of the Constitutional Court judgment as well as the firmer equity markets post the GNU. Some of the more recent activity, we've just updated this to the 31st of July, although July was fairly quiet. We bought New World, we bought Bell, we bought Mondi, we added to the likes of CUP, TFG, African Rainbow Capital, Ethos, a little bit to Amplats and 91, and we added a few big bang prefs just to kind of maintain that reasonable weighting. We either then sold or reduced some of our inflation-linked bonds, in large part as inflation sort of eases. Frankly, we felt that the capital was better deployed elsewhere. We trimmed Aspen slightly, we trimmed Bell slightly after the news of the potential delisting, and we also just took a little off the table in Coronation. Ahead of the elections, we trimmed back Standard Bank and ABSA, but have subsequently bought them back, and in fact those transactions added value. And we also sold all our British American Tobacco and BHP, and then we traded, as we indicated, the likes of ABSA, Standard Bank, Sasol, Coronation. All right, just quickly looking at the June minimum disclosure document. I hope these numbers are easy to read, but you can see on a 1-year view, pretty much in line with the benchmark. Obviously, listed property did better in the year, so that was a performance detractor, but having no exposure there. But you can see on the 3-year view, actually comfortably beating the benchmark. That on a 5-year view, which is basically goes back to almost inception, just slightly below, and in fact since inception pretty much on track with benchmark. We have little interest in the ASISA category, as we've discussed, because there's just such a funny combination of strategies and styles in there, and asset mix that it's kind of senseless. And yeah, the good news on the annualized, as we said, the 3-year, it's looking quite a bit better. So we're offering similar returns, but with less risk than the market. And of course, this is something that is important to us because the standard deviation and the drawdowns are a reflection of the volatility. As the performance has improved, obviously the standard deviation is up slightly, but we still on a 1-year and a 3-year to the end of June looking much better compared to the benchmark, and that's something we're still happy with about 1 percentage point better over 3 years than benchmark. On the total investment charge, if you go back to 2019, you can see the TIC at 2%, obviously because the fund was so small, to September 22 went to 1.7%, in September 23 down to 1.45%, and as at March 24 down to 1.35%, and all things being equal, we would expect the TIC to stabilize around the 1.35% mark. Distribution is still very solid. If you look at the income distributions between December and June 24, it translates into a yield of about 3.2%. So, not spectacular, probably only representing about a quarter of total return now, but given the fact that there's a fair investment in kind of non-yield paying value plays, that is to be expected. All right, then just a very quick update to the 31st of July 24. Performance in July, we have to say, was great, in large part driven by the GNU rally, but also I think some company or asset specific stories. So we've seen great performance from Standard Bank as our biggest holding. We discussed Bell Equipment, where we had a fairly significant weighting, which is run courtesy of the proposed delisting. So on a 1 year view, up 15.7%, let's call it, versus 12.7 on the benchmark. And again, the CISA category is irrelevant in our mind. The annualized, if you look over 3 years, up at 13.5% versus a fund benchmark of 10.8, so still very, very attractive. And 5 years, we really were in that building phase, so kind of largely tracking the benchmark, but we're very pleased with the improved performance. Obviously, given the strong performance on the 1 year view, that's seen the risk increase quite significantly, although on a risk-adjusted basis, still looking positive. So 1 year standard deviation is up on benchmark, whereas on a 3 year view, we are still below, and maximum drawdown still looks quite positive compared with the benchmark. All right, so what is the fund outlook? You make predictions like this at your peril, but we're very confident that the fund will perform. We're very confident that the asset mix is appropriate. We have confidence in the equity bucket. We think that it's going to do well relative to its benchmark, but we think it can do very well in absolute terms as well, simply because we're seeing a turnaround in a lot of those smaller cap holdings. We continue to believe in the potential of the equity bucket to deliver asymmetric upside return, and we remain rooted in our philosophy, but recognize that it's important to be flexible and not be overly rigid. So we are looking at adding resources, and are more seriously looking at the listed property space, although with a preference to those that are geared to the modern economy, which is kind of more logistics centers, storage, and kind of DCs in the industrial space. That concludes the report for the 6 and the 7 months. We hope it's been of interest to you. We thank all our investors in the fund for their support. We know it has been a frustrating journey in the South African equity market, and in a fund that's very contrarian, if we want to call it that. We're grateful for your support, and we trust that, like us, you're very pleased with the recent outperformance. And as always, we really do welcome your feedback on the video series. Whether that commentary is positive or negative, we would find it very, very valuable. So we thank you for your time, attention, and support, and we welcome your feedback. Thank you for that.